Mastering Millionaire Skills. Building a diversified investment portfolio. Number 1. Understanding risk tolerance. Before you even begin making any investment decisions, it's crucial to take a moment to assess how comfortable you are with the idea of risk. Your emotional response to risk will greatly influence your investment choices. Imagine investing in a startup company. There's a chance it could become the next big thing, but it could also fizzle out. This is what risk tolerance is all about, knowing how much uncertainty you can handle without losing sleep at night. It's not about being fearless, but being aware of your feelings and finding a balance that aligns with your financial goals. 2. Setting clear goals. Think of your financial goals as the destinations on your roadmap to success. Just like planning a road trip, you wouldn't hit the road without knowing where you're headed. Similarly, each investment you make should have a purpose. Whether it's buying a house, starting a business, or securing a comfortable retirement, your goals will guide your investment decisions. Understanding your goals and the time frames for achieving them will help tailor your investment strategy accordingly. So as you embark on your journey to build a diversified portfolio, remember that setting clear financial goals keeps you focused and on track to transform your dreams into reality. 3. Asset allocation. Asset allocation involves dividing your investments among different types of assets, like stocks, bonds, and real estate. Each of these asset classes has its own characteristics and behaves differently in various market conditions. By allocating your investments across these asset classes, you spread your risk. If one underperforms, the others may help balance things out. This strategy helps you achieve a balance between risk and potential return, tailored to your financial goals and risk tolerance. As you build your portfolio, keep in mind that smart asset allocation is like building a well-rounded team. Each member plays a unique role to ensure overall success. 4. Research and education. In the world of investments, knowledge truly is power. Keeping yourself informed about investment opportunities through continuous learning is crucial. Markets, trends, and investment options are ever evolving, and being in the know gives you an edge. Imagine you're considering buying a new gadget. You'd probably read reviews, compare features, and gather information before making a decision. Similarly with investments, being well informed helps you make confident choices. Learning about different asset classes, understanding how economic factors influence markets, and staying updated with financial news are essential components of building a strong foundation. Education doesn't just stop with school. It's a lifelong journey, and the more you learn, the more confident you'll become in managing your financial future. So as you progress on your path to building a diversified portfolio, remember that continuous learning is like the compass guiding you through the complex landscape of finance, helping you make informed decisions and achieving your millionaire aspirations. 5. Market research. Another crucial skill on your journey to mastering millionaire expertise: market research. Imagine it as keeping a close eye on trends and economic indicators before making investment decisions. Market trends are like clues that tell us where different industries are headed. Economic indicators give us a snapshot of how the whole economy is doing. By paying attention to these, you can spot potential shifts in the investment landscape. For example, if you notice more people getting jobs, that might mean they'll spend more, which could affect certain industries. Doing research isn't complicated. It's about gathering info from trusted sources and staying connected to what's happening in the financial world. As you work on your investment portfolio, remember that market research is like wearing a pair of special glasses. They help you see opportunities and challenges more clearly, so you can make smarter decisions for your financial future. 6. Long-term perspective. It's crucial to prioritize long-term gains over reacting to short-term market fluctuations. Markets can be highly volatile in the short run, often driven by various factors such as news events, investor sentiment, and economic data. However, over the long haul, markets tend to exhibit more stable and predictable trends. While it's tempting to seek rapid returns, true wealth accumulation is typically a gradual process. Consider it as building a solid foundation for a sturdy structure. It requires patience and careful planning. Attempting to time the market by making frequent trades can lead to increased transaction costs and potential losses. 7. Risk management. Implementing strategies like stop-loss orders can help protect your investments from excessive losses. A stop-loss order acts as a safety net. You set a price at which a stock or investment will be automatically sold if its value drops to that level. This preventive measure can limit your losses in case the market takes an unexpected turn. It's like having a plan B in place. However, it's important to strike a balance. Setting the stop-loss level too close might trigger unnecessary selling due to normal market fluctuations. Effective risk management isn't about avoiding risk altogether, but rather about managing it wisely. Just as a well-prepared athlete takes safety precautions before a game, incorporating risk management tools in your investment strategy can help you navigate the market's uncertainties with confidence and resilience. As you build your portfolio, remember that risk management is like having a safety harness. It ensures you're well prepared for potential bumps in the financial road, allowing you to stay focused on your path to wealth building. 8. Diversification. Diversification involves spreading your investments across various sectors, industries, and even geographic regions. This strategy is like not putting all your eggs in one basket. Different industries and sectors tend to perform based on economic conditions. Diversifying your investments can help balance the potential risks and rewards in your portfolio. If one industry faces challenges, others might thrive, potentially reducing the impact of a downturn. Moreover, including investments from different parts of the world can help you benefit from global economic growth. It's worth noting that diversification doesn't eliminate all risk, it's a tool to manage it. Diversification shields your portfolio against the impact of a single sector's poor performance. 9. Fundamental analysis. This approach involves peering under the hood of a company before investing in its stocks. Fundamental analysis entails assessing a company's financial health, management quality, and its competitive standing in the market. You're examining a company's financial statements, balance sheets, and earnings reports to understand its performance and potential. Evaluating management quality helps you gauge how well the company is being led, which can impact its long-term prospects. Moreover, understanding a company's competitive position is like knowing where it stands in the race. Does it have a unique advantage that sets it apart? This kind of analysis can help you make informed investment decisions rather than relying solely on short-term market trends. As you build your investment portfolio, remember that fundamental analysis is like a magnifying glass. It helps you see beyond the surface, enabling you to choose companies that align with your financial goals and have the potential to contribute to your wealth-building journey. 10. Technical analysis. Looking at price trends and patterns to help you make smarter decisions about when to enter or exit an investment. With technical analysis, you're examining a stock's historical price movements to identify trends, support levels, and resistance levels. Just as a weather forecast predicts possible rain based on cloud patterns, technical analysis aims to predict potential price movements based on historical patterns. This doesn't mean you're predicting the future, but rather using historical data to make informed choices. If you see a repeated pattern of a stock's price rising and falling, you might use that information to time your entry or exit. Like any tool, technical analysis has its limitations and isn't foolproof. As you construct your investment portfolio, remember that technical analysis is like having a compass. It helps guide your decisions by providing insights into market trends and potential turning points, enhancing your ability to navigate the complexities of investment decisions. Attention-savvy investors and finance enthusiasts. Unlock financial freedom and master wealth creation at BraylenAV.com. Subscribe now for a prosperous journey. 11. Value investing. This approach involves searching for investments that might be flying under the radar, but have the potential to grow over time. Think of it as finding hidden gems. You're looking for items with untapped value. With value investing, you're seeking assets that appear to be undervalued compared to their true potential. It's like spotting a discounted item in a store that you believe will become more valuable in the future. This strategy often involves looking at a company's financials, assessing its assets and liabilities, and examining its competitive position. While value investing doesn't promise quick gains, it's about aiming for long-term growth. The rewards can be substantial. 12. Income investing. Including assets in your portfolio that generate a steady stream of income. Think of it as having a side gig that pays you regularly, even while you're sleeping. Income-generating assets can take the form of dividend-paying stocks, bonds, or even rental properties. These investments provide you with periodic payments, much like receiving a paycheck. Dividend stocks, for example, pay out a portion of a company's earnings to shareholders, providing you with a slice of the company's profits. Rental properties can offer monthly rental income, contributing to your financial stability. Income investing is like creating multiple streams of income. You're building a solid foundation that supports your financial goals. While it might not provide sudden wealth, it can offer a consistent and reliable source of funds. 13. Risk-return trade-off. Let's delve into a fundamental principle in mastering millionaire skills, the risk-return trade-off. This concept highlights that there's a connection between the level of risk you take and the potential returns you could earn. In the world of investments, it's essential to understand that seeking higher returns often involves taking on more risk. For example, stocks can offer significant growth potential but come with the possibility of larger price swings. On the other hand, lower-risk investments like bonds might offer more stability but generally yield lower potential returns. This principle underscores that there's no one-size-fits-all approach. It's about finding the right balance between risk and potential return that aligns with your personal financial goals and risk tolerance. As you build your investment portfolio, always keep in mind that the risk-return trade-off guides your decision-making process, helping you make informed choices that match your aspirations. 14. Liquidity management. Finding the right balance between having readily accessible funds and making longer-term investments. Think of it as managing your wallet, having some cash on hand for daily expenses while also putting money aside for bigger goals. In the world of investments, maintaining liquidity is crucial for financial flexibility. Liquid assets, like cash or easily tradable securities, can be accessed quickly, which is helpful for emergencies or unexpected expenses. On the other hand, longer-term investments, such as stocks or real estate, may take time to convert into cash. Striking the right balance is like building a financial safety net. You ensure you have enough cash to cover immediate needs while also making your money work for you through investments. While it's tempting to put everything into long-term investments for higher potential returns, having a mix of liquid and longer-term assets provides a cushion against unforeseen circumstances. As you shape your investment portfolio, remember that liquidity management is like finding the equilibrium between short-term needs and long-term growth, ultimately enhancing your ability to navigate the financial journey with confidence. 15. Regular review. Just as you periodically check your schedule to stay organized, it's a must to assess your investment portfolio's performance and make adjustments as needed. Markets, much like life, are dynamic and subject to change. By routinely reviewing your portfolio, you can ensure it stays aligned with your goals and risk tolerance. This involves examining how each investment is doing and considering whether it's still in line with your expectations. For instance, if a certain investment has significantly grown and now constitutes a larger portion of your portfolio, it might be time to rebalance to maintain diversification. Similarly, if an investment isn't performing as expected, you might need to reconsider its place in your portfolio. This practice isn't about chasing short-term trends, but rather about keeping a finger on the pulse of your financial journey. 16. Behavioral discipline. It's vital to overcome emotional reactions to market volatility and adhere to your investment plan. Markets can be like a roller coaster, with ups and downs that can trigger strong emotions. However, letting emotions drive your investment decisions can lead to impulsive actions that might not align with your long-term goals. Behavioral discipline is about having a steady hand on the wheel even when the road gets bumpy. It involves understanding that market fluctuations are normal. Instead of reacting to short-term swings, focus on your well-thought-out investment strategy. Having a plan and sticking to it can help you weather the storms. Just as a runner paces themselves to cross the finish line, maintaining behavioral discipline helps you stay on course toward your financial goals, allowing you to build a diversified investment portfolio that stands the test of time. 17. Understanding bonds. Bonds can be thought of as loans you provide to companies or governments, and in return, you receive regular interest payments. It's like lending money to a friend who promises to pay you back with a little extra for your assistance. There are various types of bonds available, each sharing the same fundamental idea. Bond ratings serve as indicators of the borrower's creditworthiness. Just as understanding a friend's reliability influences your decision to lend them money, comprehending bond ratings helps you assess the risk associated with lending to a particular entity. Interest rate movements play a crucial role in the world of bonds. When interest rates rise, existing bonds with lower interest rates can become less appealing, leading to a potential decline in their prices. Having a grasp of this dynamic can contribute to your ability to navigate the bond market more effectively. 18. Stock Market Insights. Let's delve into a valuable skill on our journey of mastering millionaire skills, gaining stock market insights. Market indexes such as the S&P 500 or the Dow Jones Industrial Average represent a collection of stocks from different companies. When these indexes go up or down, they provide insights into the overall performance of the stock market. Think of it like checking the weather forecast before planning an outdoor event. It helps you make decisions. If the market index is rising, it indicates that the majority of stocks are gaining value. On the other hand, a declining index might signal a period of uncertainty. Understanding these insights can guide your investment decisions. Just as reading a map helps you navigate a new city, interpreting market indexes helps you navigate the financial landscape, assisting you in building a diversified investment portfolio that aligns with your long-term financial aspirations. 19. Real estate investments. Real estate investments involve owning properties like homes, apartments, or commercial spaces. Learning about real estate markets and property valuation techniques is akin to understanding the rules of a game before playing it. This market can be influenced by factors like location, supply and demand, and economic conditions. Just as exploring different neighborhoods gives you insights into their potential, understanding these market dynamics helps you identify promising opportunities. Property valuation techniques help you determine the fair value of a property, ensuring you make informed decisions. Whether you're considering rental income or property appreciation, real estate can be a part of your diversified investment portfolio. 20. Global exposure. Think of the global market as a vast playground filled with various opportunities. Considering international investments is akin to broadening your horizons to tap into global economic growth. Just as experiencing different cultures enhances your perspective, diversifying your investment portfolio to include international assets can potentially amplify your financial prospects. International investments can involve stocks, bonds, or funds from companies and governments around the world. These investments allow you to benefit from economic growth in different countries, even if your local market experiences fluctuations. It's like having multiple income streams from various sources. While investing internationally can offer diversification benefits, it's crucial to understand the risks associated with different markets and currencies. 21. Alternative investments. Commodities, hedge funds, and private equity. Alternative investments have the potential to act as a source of diversification, helping to manage risks in your portfolio. For instance, commodities like gold or oil can behave differently from traditional assets. Hedge funds and private equity offer opportunities not always available through public markets, potentially bringing unique potential returns. It's important to note that alternative investments can come with complexities and higher levels of risk, so thorough research and understanding are essential. Just as an explorer considers different paths to reach a destination, integrating alternative investments into your portfolio can bring depth and potential to your financial journey, potentially contributing to your financial success. 22. Behavioral biases. Think of these biases as subtle influences that can sway your decision-making process without you even realizing it. Being aware of cognitive biases is like having a mirror that reflects your thought patterns, helping you make better investment choices. Our minds are wired to take shortcuts, and these shortcuts can sometimes lead to errors in judgment. For instance, confirmation bias can make you seek out information that aligns with your existing beliefs, potentially blinding you to opposing viewpoints. Herd mentality, on the other hand, can lead you to follow the crowd, without critically assessing your choices. Recognizing and overcoming these biases is akin to fine-tuning a skill. It requires practice and self-awareness. 23. Stress testing. Think of stress testing as a way to put your investment portfolio through different scenarios to see how it holds up. This involves considering different scenarios, such as economic downturns or interest rate hikes, and analyzing how these changes might impact your investments. Stress testing is a proactive approach to managing risk, helping you identify potential weak points in your portfolio and make adjustments accordingly. It's not about predicting the future, but rather about being well prepared for a range of possibilities. Remember that stress testing is like having a safety net. It offers insights into how your investments could weather different financial storms. 24. Continuous adaptation. Just as life throws curveballs that require adjustment, your investment portfolio should also evolve to reflect changing circumstances. Staying flexible is a must that allows you to navigate various financial scenarios. Your financial situation, goals, and market conditions can change over time, and your portfolio should adapt accordingly. For instance, as you earn more or your priorities shift, you might need to rebalance your investments. Similarly, economic changes can influence the performance of certain assets. Continuous adaptation means keeping an eye on the bigger picture and making strategic adjustments when needed. This practice is about being proactive rather than reactive, allowing you to stay on track toward your financial aspirations. As you craft and nurture your investment portfolio, remember that continuous adaptation helps your portfolio stay in harmony with your evolving financial journey, enabling you to build a diversified investment portfolio that remains aligned with your ever-changing goals. Within mastering Millionaire skills and building a diversified investment portfolio, remember that you hold the keys to your financial destiny. Each skill acquired, you've fortified your ability to seize opportunities, manage risk, and sculpt a future of abundance. Just as a masterpiece is created stroke by stroke, your portfolio evolves through decisions and a commitment to growth. As you step forward, let this newfound expertise be the compass guiding you through the dynamic landscape of finance. Embrace the challenges, celebrate victories, and continue to refine your skills. The path to wealth is not merely about the destination, but the remarkable journey of empowerment you've undertaken. Your portfolio is a canvas, paint it boldly, with the colors of diversity, wisdom, and prosperity.